Okay, it's gonna be a wild one. What's up, everybody? Nate here. And over the weekend, we witnessed two of the largest banking collapses that we have pretty much ever seen in American history. Silicon Valley Bank and Signature Bank were taken over by government regulators as they were citing systemic risk with those banks. That put hundreds of billions of dollars worth of deposits and money on the sidelines as investors and startups were no longer able to access that cash. And President Biden, the Federal Reserve, and Treasury Secretary Janet Yellen had to step in. Now, this is a really scary situation because billions of dollars were essentially hanging on the line and people weren't sure if they were going to be able to get their savings out of these banks. That meant that there was fear going around for private investors, public investors, startups, regular Americans, you name it. So today I want to kind of talk about why this happened, what this actually means to you as an investor and American, and what we can expect from these banks and our federal government going forward. Silicon Valley Bank was the second largest banking collapse in US history, right behind Washington Mutual in 2008. Now, what you need to understand here is the reason that Silicon Valley Bank essentially collapsed was because of what Silicon Valley was investing in. It was investing in a lot of tech startups, and it was investing in a lot of mortgage-backed securities. Now, we know in the United States that many tech startups have taken a huge hit because of economic conditions, consumers not spending as much because of inflation, and the Federal Reserve raising its interest rates in order to combat inflation and bring down demand. Silicon Valley Bank did a lot of business with tech startups, so many of your tech startups have money in Silicon Bank. They actually deposit most of their funds and use that to pay their employees or invest back into their company. That's where they hold their money. Now, in 2020 and in 2021, there was a ton of money that was pumped into Silicon Valley Bank, hundreds of billions of dollars. This is because interest rates were low and there was a lot of people investing money. So the bank was sort of riding high, and these tech startups then deposited a lot of their money into Silicon Valley Bank. Conditions now, though, have changed in 2023. These tech startups are not receiving as much capital. They're not receiving as much funding. So they are actually using a lot of that cash and they're burning through a lot of the money. That immediately caused a lot of concern for Silicon Valley Bank because they don't have as much money to use, and because these tech startups aren't getting as much funding either, Silicon Valley Bank is basically going through all of its cash and it doesn't have as much cash to invest. So it was slowly losing money on its balance sheet, but that is not the whole problem here. The other half of this problem is losses that it took on from mortgage-backed securities and bonds. Mortgage-backed securities are a valuable asset when a lot of people are buying homes and when lots of people are paying their mortgages on time, but over the last 6 to 8 months or so, mortgage-backed securities have gone down in value because the Federal Reserve has started to raise their interest rates. So not as many people are buying houses, housing values are going down, so that asset is getting a lot more risky, and Silicon Valley Bank had a ton of money pumped into mortgage-backed securities. Now, to be completely transparent, these mortgage-backed securities are very much different than what they were in 2007, back when the housing market essentially crashed because of them. They're a lot more heavily regulated now than they were then, but the issue isn't the asset itself, it's the amount of leverage that Silicon Valley Bank had in this asset. Silicon Valley Bank realized that these mortgage-backed securities were losing money, so they started to sell them off at a loss, which meant even more money was flowing out of the bank than into the bank. This started a domino effect for everybody that had money in the bank, because now depositors like VC firms and startups who had money in the bank started to see that this bank was losing a lot of money, and when banks lose a lot of money, then they lose the ability to repay all of the people who have money in the bank. What happened next was your classic run on the bank. You had thousands of startups and VC firms go to the bank and withdraw all of their funds, and when that bank ran out of all of its funds, now it wasn't able to pay back its debts, and for the people who still had money in the bank, it wasn't going to be able to give them all of their money back either. Now, an important side conversation that you need to understand here about the banking system in the United States is banks make money when you give them money. So when you take, say, $100 and deposit it in the bank, say in a savings account, well, the bank then takes this money and uses it to invest. It is a liability for the bank to hold on to that money because it is just sitting cash, losing them value. They take your $100 and they invest it in mortgage-backed securities. They invest it in startups. They go out and invest this money. So your $100 is was essentially gone. Now they get money back on that, but the problem is they rely on everybody keeping their money in all at once, and if everybody pulls their money out, then they don't have any other money to give back to their depositors. That is exactly what happened to Silicon Valley Bank. They didn't manage their risk properly, and they over-leveraged themselves in mortgage-backed securities and bonds, and because the Federal Reserve was raising interest rates, those assets lost a lot of value. They started selling them off, which created sort of a lot of fear amongst VCs and startups to take all of their money out. That caused the federal government to have to come in and take over the bank. Now, normally when a bank collapses in the United States and it isn't able to give all of its depositors all of their money back, something called the FDIC, or Federal Deposit Insurance Corporation, steps in. That means $250,000 is protected for all account holders at that bank, so they should essentially get all $250,000 back. And the issue is, and what kind of started the pandemonium and panic, is a lot of your startups and VCs have way more than $250,000 in the bank. They have tens of millions of dollars. So anything above $250K is uninsured, which means that you're not going to get that money back on a regular basis. But that's not exactly what happened this time. The federal government essentially stepped in this time and said that they were going to give back all account holders and all depositors all of their money back. So even if you had more than $250K at Silicon Valley Bank, you are going to get your money back. Now, they did the exact same thing when Signature Bank closed on Sunday. They actually had to take over Signature Bank because it was connected to a lot of crypto companies. And it went under for pretty much the exact same reason. Crypto companies were booming in 2021 as Bitcoin and other cryptocurrencies set new record highs. But now, as that space has shrunk, all of those companies are burning through their cash and they're not getting as much funding. And everything else that this bank had leveraged into, whether it was crypto or other types of securities, now those funds are disappearing too, and it's taking losses. Investors started to see this, and people who had deposits in the bank started to see this. So again, they went to the bank and withdrew billions of dollars worth of funds all at once, and the bank collapsed. On a smaller scale, the exact same thing happened just a few weeks ago with Silvergate Bank and its connections with crypto. So that is why Silicon Valley Bank and Silvergate and Signature Bank all collapsed over the last couple of weeks and this past weekend. But here's where things get interesting. How exactly is the federal government now going to give back billions of dollars worth of reimbursements to everybody who lost money? This is a really sticky situation because if the Federal Reserve just prints money, well, that is going to completely undermine everything the Federal Reserve has done with raising its interest rates. That'll just cause more inflation, so it doesn't really want to take that route. The other option is for other banks to step up like they did during the 2008 banking crash and take on all of these bad assets that like Silvergate and Signature had bought. Because they're well diversified and they have the cash to do it, they can take on these assets and then sell them at a later date or compact them into something that actually is going to work. Pretty much no bank over this weekend was willing to do that, so that only leaves one other thing: taxes. The initial idea was for Janet Yellen and the Federal Reserve to pull billions of dollars worth of taxpayer money in order to fund these supposed bailouts. However, Janet Yellen and President Biden and Federal Reserve Chairman Jerome Powell were extremely against the bailout method. They didn't want to use taxpayer dollars to do it, so they took another route. The federal bank is going to offer a line of financing to all of these collapsed banks for at least the next year or so, and they're going to be able to pay off a lot of their debts and all of the losses that they've taken on their assets. In exchange, they're going to have to give the government some high quality assets like mortgage-backed securities and treasury bonds. The US can then sell a lot of these bonds, and whoever buys the bond will have to pay back interest to the United States government. The interest that is created will go towards the financing. Plus any fees from other banks that hold on to a lot of these assets already and pay them to the federal government, well, that money will also be used to help the banks out. Now, the Treasury Department has made around $25 billion available just in case the fees and the interest payments don't cover all of the depositor funds. But at the end of the day, these banks collapsing shouldn't, according to the federal government, cause any taxpayers to have to pay any additional funds. Now, what we can expect from the future is a whole slew of other banks experiencing similar issues. First Republic Bank right now is very close to being taken over by regulators, although as of recording recording this video, it has not yet, but it could be the next bank to sort of collapse in the United States. Mortgage rates actually dipped as of recording this video because investors and banks believe that the Federal Reserve is going to now have to stop raising interest rates so high because many banks are starting to fail and their interest rates are having a profound effect on mortgage-backed securities, so they can't raise them anymore or else more banks are going to fail. But that is neither here nor there. Here's what you need to know about these banks failing. Whether you are a startup or an investor or just somebody looking to put money in the bank, you need to do as much research as you can on which bank you actually choose. Do some research on their reputation. Do as much research as you can on what assets they hold. Banks want you to save as much money as possible. That's how they make even more money. So you have to be very careful with your funds and only keep as much as you need in the bank. Not only that, but nobody wants to see their bank go under, so you have to be very careful on which bank you actually choose. I don't think the message here is to not trust any banks at all. There is a lot of fear and panic and misinformation going on circling around right now, but what you need to know is that banks are an important tool in your financial plan. You just need to pick one that you can actually trust. Pretty much no bank is going to tell you that they have some problems until those problems actually arise because they don't want to spark fear and panic amongst all of their customers. Because as soon as the bank says they're taking losses and they're not sure if they're going to be able to give everybody their money back, now people go to the bank, they take all of their money out, and that forces the entire banking system to essentially collapse. This is why financial education is so important and why you need to do your research on the assets your bank holds and its reputation in the finance world. The banks aren't going to tell you all of this, which means you need to know how to use a bank and you need to know what a bank is for in order to actually put your money there safely. What this entire situation boils down to, in my opinion, is a really mismanagement of risk from a lot of these banks. They were over leveraged in startups, in crypto, in tech, mortgage-backed securities, you name it. A lot of these things are really, really high risk, but they are also really high reward. So it makes sense to invest in them when there's a ton of money and really low interest rates. But now that times have changed, these banks just didn't diversify well enough. And now they have completely failed. After the 2008 crash, where a lot of your big investment banks like Lehman Brothers essentially collapsed, a lot of regulations were added to the industry, like the Dodd-Frank Act. It is a consumer protection, so this means that banks have to go through a lot more regulation and do a lot more risk management with their banks. But as things kind of recovered after the great financial crash, the Federal Reserve kept its interest rates low and our economy essentially went back to normal, a lot of these regulations were lobbied by your banks and pushed back on. So in 2018, many of the regulations that were passed in Dodd-Frank basically disappeared. It is way too early to call, at least from my side, whether this is going to be a systemic issue because I don't have the balance sheet of every single major bank in the United States in front of me. All I can tell you is this: many of your big banks, even like JP Morgan and Bank of America, are now kind of facing a lot of fallout because of this, out of the fear and panic. You unfortunately can't control anything these banks have done. You can't control what the bank does with your money after you deposit your funds. You can only control how you react to it, which bank you choose, and how financially educated you are. That will help prepare you and give you an idea of what you need to do as this situation unfolds, because we don't know what's going to happen next with a lot of these US banks. Obviously, the situation is ongoing, so I wanted to make a video on the most up-to-date information as I possibly can. But if you want to stay up to date even more with all of the latest financial news all throughout the United States, we're talking economy, we're talking Fed, we're talking inflation, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if video is more your thing, I'm putting out updates 7 days a week, breaking down all of the top business and financial news all throughout the United States. So if you want to subscribe, be sure to do that before you go. Finally, it is a crazy, crazy world out there, everybody. So don't let the fear and panic or FOMO take control of you. Stay as educated as possible. Stay in the know with everything going on as much as you can. And of course, be kind out there, and I'll see you all in the next one.